Hello accounts people, as it says on the screen, we're going to look at how everything will fit together. So let's just explain. Thinking about a small business account, so I'm going to show you limited company and sole traders version of a couple of accounts. And I'm not going to actually do the ledger work or anything like that. I'm just going to explain the over picture. There's plenty of videos with double entries being turned into trial balance. That takes a long time. I think the shortest I've ever managed to do that exercise in is about 45 minutes. So we'll just do a short preview and explanation, focusing on the understanding rather than the actual practical side of it, but with all the stages and steps, focusing on computerized versus manual. So if you're doing a manual, you're doing what's on the left hand side. So I haven't titled it actually, but we balance our accounts off. So anybody who's ended up being an accountant at the moment will have learned to balance off accounts first, and they'll have learned the manual system, because then you are in control and you understand what your package, your software, whether it's Sage, Xero, QuickBooks or a dedicated version of it, is doing. And you can also learn to be better at and quicker if you've learned the manual system first. There is still a time for the double entry skills. On the manual system though, we then complete the trial balance, the brought down balances, although they're dated as the carried down balances, one of the oxymorons in accounts. So it's the brought down side dated the carry down. Oh well, I've never understood why that one is, but it's always been the case. It's one of the things you just learn and accept. And then of course you come to the end of the year, we've got lots of adjustments. Even for a fairly small business, they may have paid rent in advance or they've got a bit of depreciation. Tends to be an end of year one, and also review receivables and things like that. So we'll have a look at some adjustments. There's a bit of a story behind typical set of adjustments. Now on a computer package, we can just click a few buttons and actually we could zoom it straight off without looking at it, without checking it off to the tax authorities and Companies House and print it out. That's never recommended. We need to check and understand and just be able to explain it to clients and people we're working for. So we would export the trial balance from the software. It goes down as a CSV, so it's very easy to put into a spreadsheet from a CSV file, and then we can do our end of year adjustments on this. I know accountants who work different ways, so if you export it as a CSV, work out all the adjustments, you can then, as per 2B, put the adjustments as journals into package. Now those journals are one of the main reasons you learn the double entry system. When you enter journals into a package like Sage or Xero, you have to tell it whether to debit, whether to credit, and make sure you've got it the right way round. The other main reason is actually as a sort of sketch pad, as a working out one. So that's ultimately the main practical day-to-day use of double entry skills. So once we've got to that point, okay, in my manual system I'm going to complete an extended trial balance. So extended trial balance, I'll show you in a minute, is the version with columns for the profit and loss, for the balance sheet, statement of financial position, and usually a columns for adjustments. And then from that I can directly complete on the same spreadsheet if needed my financial statement. I can just link the figures, therefore I'm not going to make any typos, and then check it thoroughly, make sure. And then I've got all the information there if I need to do the slightly different versions for Companies House or my tax return, or the sole trader's tax return. On the computer system, yes, export the trial balance once I've updated and put the adjustments in. Don't always have to do that. Then I can use them again for preparing my financial statements on my spreadsheet. There is the option in most software packages to complete the income statement and profit and loss, or profit and loss balance sheet, statement of financial positions, and the other documents. If it's a limited company, it will update or change in equity for you as well. However, some companies prefer to have a separate package where they can check it and submit from that, or they just turn it into a spreadsheet and then upload that. So lots of different versions in the real workplace. Some software is better at submissions than others. Right, let's close that one. And then what have we got in front of us? We've got some T accounts. So yes, lots of T accounts. This is just straight out of an Osborne book. Assets, liabilities you've learned. Here's some that are actually balanced off. So it's the brought down balance that goes in the accounts, but dated to carry down. The weird thing. So purchases ledger, general ledger, sales ledgers, just learn to do that. It matters, understanding it. Of course, on a computer package, you can print it out like this, or print out different versions of it. Sage, you've got a few different buttons, different numbers of columns, different rows, versions that you can print out. Just some people like having a physical, tangible printout in front of them to go tick, 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 tick. Yeah, I know what that is. I know what that is. Verifiability. Other companies, other accounting bodies prefer the idea of daybook. So daybook is literally just a list of invoices and credit notes. Some companies prefer to have the list as well as processing into Sage. Not a bad idea sometimes to type it all out into a daybook before you put it into Sage. People who worry about Sage being correct, maybe manually trained bookkeepers, learnt properly in the past before the days of Sage and QuickBooks and Xero, and therefore they still prefer to do this, and they can actually reconcile their daybook totals in their own version of receivables with the computer, which means there's no room for error, no room for missing off that important sales invoice. If you just were working through a pile of sales invoices and you forget to type one into Sage, it's gone. That's money lost, money down the drain. If it's a purchase one, it won't be lost because the supplier is going to be ringing you and saying, why haven't you paid it? And it's because somebody turned over two at once and made a mess. So it does happen all the time. Especially with purchase invoices, because remember they are A4, triplicate, duplicate, emailed, printed, posted. Easy for them to stick together when you've got different size ones from different companies. Of course, your own sales invoices are numbered, so you should really spot a number that's missing, because they should be sequential. So our trial balance, so we've balanced off all our accounts, we've got to our trial balance. So this one, I know I've done this one manually, it isn't a download from Sage or anything like that. It's got payables, ledger control, so it's relatively recent, PAYE, and I'm just going to put that into our debit and credit columns, and then hopefully it will balance. This one does balance off nicely. There's not even a suspense account in it, so I must have done some corrections in the first place. Quite useful. Of course, you should have learned to always obviously add up the rows, make sure everything balances. Add up the columns, and add up the bottom two numbers, make sure it balances. It's very easy on the spreadsheet. It's what spreadsheets are actually invented for. And then you should learn, obviously, two numbers the wrong way around. I better do a quick demo having mentioned it. Any difference is divisible by 9. 18 is a multiple of 9, but only works for one typo. If you're manually typing in, anybody can do two numbers the right way around, get the fingers in the wrong order. Also, something's on the wrong side. Okay, we don't recognise 313.92, but if I go divided by 2, oh, I know what that one is, I've got it the wrong side. Back to what it should be, which means when I close it, I can say it don't save the changes. So our extended trial balance, this is the full-blown one of my teaching ones. So rather than actually do this in front of you, there's plenty of exercise and videos where that's been done online. So our initial ledger balances, whether they're off our manual system or whether they're exported, then the adjustment. So this is they tell a story about the end of the year. This one is actually a mixture of errors, We might as well just have a typical set of adjustments. Some of the numbers balance up. I can't remember what the 1410 was from, but the cash, why would cash not be counted? Well, it's in somebody's wallet, it's in the glove box of the van or something like that. And then you suddenly be, oh yeah, there's another £125 somewhere. Very easy to do. And then the drawings, you can see a classic one. The owner's taken actually £2,000 out of goods for their own use, so return it from purchases into drawings as long as the accountant knows. And then the accumulated depreciation has just got another £200 depreciation on it as a natural end of year adjustment, not an error of any description. General expenses, there's an accrued or prepaid expense here. Again, a lot of sole traders and small business people, they just wouldn't understand the concept of a prepaid expense, so that's what we tell them. Oh, you're way ahead on your rent, we'd better put it in because it does matter to the profit figure. If you didn't treat it as a prepaid expense, that £400 would be added as an expense, we'd be wrongly reporting. In case of a prepaid expense, we're moving into next year and therefore getting the correct profit figure. There's a 2,700 here that was our suspense account. Somebody forgot to code or put in what that 2,700 was, and I think the story behind this £250 here was that they didn't realise they'd made a last minute payment, maybe the last day of the year or something like that, so they owed £250 less. It's always good to owe less money. And then loan interest, yeah, you wouldn't actually see loan interest until just after the year, and of course it's accrued under the accruals. We want the correct amount for the year. That £150 would have come in an email maybe part way through the next month or the month after. If it's paid quarterly, it could be 2 months after. We have to make sure we put the interest that belongs in the year ending 31st of December in this case in. Then our opening inventory, that's off last year's ledgers, that's last year's closing inventory, and there's the purchases being reduced by the drawing. And then our sales, just a little adjustment, that £500, I'm not sure where that was from. Oh, there's an accrued expense here, I don't know, maybe that's just a natural error or something. Just going down. Our rent is actually £500. I can't remember what I did with that one. Oh, it's an accrued expense, so we were £500 behind on rent. And then there's a £15 commission forgotten about. And then RLCA and PLCA, yeah, why not save a bit of paper, put them on the same row, because debits is the receivables, credit is the payables. Some people even put purchase and sales on the same row. And in fact, further down, I've done closing inventory on the same row. Makes it easier to fit on the screen. I've already mentioned the accruals and the prepayments, the accountant's knowledge of advanced bookkeepers anyway. And then the closing inventory, yeah, I'll just put it on one row. In fact, you could actually put the opening inventory on the same row as well, because in the profit and loss it's on the debit side, so you'd still see the opening inventory, or is it 3,400 here, save a row. Irrecoverable debts, yeah, end of year, look at all the debts, just check, we've added another £250 to it, and then there's our £200 depreciation being added to our existing amount. Maybe we made a purchase or something. So every adjustment tells a story. We can update our trial balance. You won't generally see that in most exam questions, the updated version. They'll go straight into the profit and loss or financial position just to fit it onto a screen. It's extra columns in the exam. The sort of software that exam boards use, you cannot have this many columns on. And that's the only reason they don't show you them. So profit and loss is income and expenses. Income on the credit side, debit the expenses. Of course, when we've got things like purchase returns, they are on the credit side, but they're still a purchase account, just as a sales return belongs in a category of sales. Notice one of the thorny issues, always students picking up from somewhere that drawings are an expense. No, otherwise it would be here. It's not. It's the owner taking out the capital. Like a sales return is a sales that's come back. Purchase return is a purchase that you've sent back. Drawings is the owner taking their own capital out, the money they need to live off, and it's not as an expense and shouldn't really be taught as that by anybody. I know it's a bad habit that happens everywhere. They've got bank overdraft, capital, so all the assets and liabilities and capital items, whether they're on the debit or credit side. Now the balancing figure we can now see, that's the actual profit figure. So the big advantage of doing everything this way is you've worked out the profit figure. So when you go to draw up the accounts, you know what you're aiming for, or you know what the end result would be, so we don't miss anything out. Always good practice to double check. So let's have a look at our income statement or statement of profit and loss completed for this. So sole trader here, there's his revenue, opening inventory, purchases. Don't have to be done in 2 columns, however accounts should be understandable and clear. Putting the subtotals across does help our sole trader, and of course we've got a commission here as sundry income, so interest received would be there, discounts received would be there as well, and it does allow us a little bit of explanation there. So we know the cost of goods sold, so we can do the ratios and all the calculations, and then our list of expenses in whatever order you want to put them, whether you want to put them all direct ones at the top and the less direct ones at the bottom, or whether you put it in alphabetical order, doesn't matter. But our sole trader is interested in all this information. It's their expenses, it's their personal liability, which is why we're quite interested in having a big long list of expenses. It all makes sense to our sole trader. And then our balance sheet, this is the balance sheet format, not a statement of financial position format. Again, our sole trader, it's their equipment, it's their personal possession in a way, because they're the same legal entity. So actually seeing the breakdown of cost and depreciation matters. Same would be with a van. Seeing the inventories, receivables and cash laid out separately is important, useful information to them. If you're a shareholder limited company, you wouldn't really be bothered about all the nitty-gritty minor information. You probably wouldn't even be worried about seeing the current assets total. And then our current liabilities, just on a different column to this one, for make it clear. It doesn't matter whether it's that, there could be that column and that column or whatever, just a different column so it's clear, so you don't get confused. It's presentability. And then our net current assets, non-current liabilities, and then we've got our net assets, net assets being the non-current liabilities, minus the loan plus our non-current assets, sorry, our net current assets plus our non-current asset minus the loan. Get that right. The 5890 is 2,900 plus the 5,740 minus the 2,750. If we hadn't got a loan, it just wouldn't be in the calculation. And that is the balancing figure on this one. We could balance it up to in different ways, as long as it's understandable. It doesn't matter. The balance sheet version, statement of financial version, is actually a little bit more varied from accountant to accountant, company to company, than our profit and loss figure or income statement. And then our capital drawings, of course, where it belongs in the balance sheet, not as an expense in the income statement, profit or loss account. Opening capital minus the drawings, plus the profit minus figure. Okay, we often don't put minus figures in accounts. We'd rather write less drawings just because it's small and can be easily misunderstood. But there's our 1550 profit coming in. I think I've said most of the reasons for all the adjustments, all sorts of things. Yeah, a lot of timing issues, but also obviously correcting any errors that are found as well, or anything misrepresented. So let's just have a look at another couple. So remember, this is the end result, one way or another. Obviously, again, UKGAAP, generally accepted accounting practice. Other countries have their own version. in the two columns because it's nice and clear for our sole trader. Again, the list of transactions that make, but if we had the same trading for a limited company, we would produce a very different version. It still starts off with revenue at the top and still down to the profit at the bottom, and it's still in the orderly fashion. However, let's have a look at the limited company version. One column normally. You can present it to shareholders in different columns if you want. As long as the end version that is submitted for public viewing is in the correct IAS version. Notice sales revenue. We don't need to show the breakdown of cost of goods sold. That would normally be in the notes section. And also the fact that we've grouped our expenses now. We only need to show cost of goods sold, admin expenses, selling and distribution expenses, and finance costs. Everything gets grouped into those headings. And then the profit loss before tax, it's the same number, except of course now the business itself pays the tax. So the profit or loss from continuing operations that can stay in the business or be given out as dividends is 16,200, not the 20,007 figure. And it's pretty much the same concept with a balance sheet, so just a different version, a different balance sheet in this case. So with the three columns, I've even put in a less allowance on this one, allowance for doubtful debt. So yeah, a lot of people just put the 17052, hoping they don't get asked questions on it. Trying to quickly tutor a central heating engineer, might be the best central heating engineer in the world, but trying to explain to them allowance for doubtful debts. Don't need to, it's not understandable, not useful information. Prepayment, so is relatively easy to explain, the amount of money in a bank as well, and all the liabilities, SVO, HMRC, etc., and loans. And then where you started off with, what you've taken out, add back in what they've made as a profit. So yes, just a reminder actually on my handout about the misunderstanding of the very annoying when we have to correct students and they learn that drawings are not an expense. Hopefully you've been taught right. So the limited company version, so same idea. Well, we've got rid of the three columns, we can put that in the notes. So there are 5 financial statements for limited companies: income statement, profit and loss, statement of financial position, balance sheet, change in equity, cash flow statement, and the notes, the 5th element. They are quite important, so we can put any minor little detail in case anybody's interested in the notes, and just put an item, every class 1 figure, and this goes to be the carrying amount. And then our current assets, inventories, trade and other receivables, that would then include prepaid expenses, and cash equivalents. So we're not splitting cash and bank, it's not of any interest to shareholders in a limited company. And ultimately these are officially prepared by the directors of the limited company for the shareholders. So we've now got a total assets figure, that's the balancing figure. And then, okay, slightly alteration, the equity and liability is here as opposed to down here. In other words, non-current. It's actually consistent, non-current assets, non-current items, current items at the bottom. So there is a consistency there. It's now called share capital and retained earnings. So revaluation is usually just for property, where property's gone up over time. And then a bank loan, there isn't one here, but I'll put one in just to show. And then current liabilities, notice again, just different layouts, no need to put in all the minor detail. Trade and other payables, HMRC for VAT, and then our tax liability, because it's owed by the business, whereas the sole trader has to fill in their own self-assessment at the end of the year, and it's their income tax that they're actually paying. And notice the rate balances are 71307, and that's our financial statements done from double entry, trial balance, whether we use a package or not, lots of adjustments, and then prepare the financial statements for our clients.